Welcome to the Investing Insights podcast from Morningstar.com. This podcast is brought to you by the Morningstar channel for Roku. Enjoy insightful, independent video content in your living room. Download the Morningstar channel to your Roku today. This week on the podcast, RJ Hotovy gives his take on Restaurant Brands International. Mark Miller discusses the long-term care industry. Russ Kinnell tells us that a high yield can sometimes be a red flag. We think Expedia is undervalued, and we share 3 attractively priced utilities with good total return prospects. So let's get started. Here's RJ Hotovy discussing Restaurant Brands Dividend.
Restaurant Brands International, the parent company of Burger King, Tim Hortons, and Popeye's Louisiana Kitchen, has quietly become one of the more intriguing dividend stories in the restaurant space today. On its most recent quarterly update, the company effectively doubled its dividend payout ratio, now paying $1.80 annually, representing a 3% dividend yield. This puts the company in the upper echelon of dividend yields in the restaurant space today, even after Restaurant Brands and a number of its competitors have sold off company-owned locations to franchisees, taken on additional debt, and used those proceeds to return cash to shareholders. We expect the payout ratio to remain comfortably below 60% for the foreseeable future and grow at a high single-digit clip. Our confidence is backed by the company's unique master franchisee joint venture structure, where it assigns franchising rights in a given region to a well-established, well-capitalized player. With the company making some brand acquisitions the past couple of years, including Tim Hortons and Popeyes, we believe these master franchisee joint venture partners will have a lot of brands at their disposal to grow over the next several years, and in fact expect the company to grow its top line at a healthy mid-single-digit clip, thus giving us confidence in the company's ability to pay out a dividend. Because of the annuity-like structure, restaurant franchisors have typically been a very reliable source of dividend payout and dividend growth over the past. However, we do see 2 potential risks to our projections on dividend growth for Restaurant Brands International. The first is a threat of a large acquisition. The company has been inquisitive the past couple of years, but there's rumors circulating that the company may be looking for a larger brand like Domino's Pizza, Yum Brands, or another large QSR chain. While the company's historically been able to balance acquisitions with dividend payouts, something this large may disrupt the company's potential to make a payout. The second is the threat of a recession. While we're not anticipating anything like the Great Recession that we saw in 2008 and 2009, restaurants have generally had a pretty strong track record the past decade and could be due for a cyclical downturn. This could potentially impact sales at Restaurant Brands International's locations, which would impede the royalties they receive from franchisees and in turn could disrupt the company's ability to pay out a dividend. However, looking across the space, this is one of the most globally diversified and well-run companies in the restaurant industry. And so we would think that they would have one of the best chances to maintain a dividend payout even under these circumstances.
Overwhelmed by the market? Morningstar Premium will help you cut through the noise and find the most promising investments. Get started today with Morningstar Premium.
Now, Mark Miller examines the state of the long-term care industry.
Hi, I'm Christine Benz from Morningstar.com. Long-term care costs are the biggest wild card in many retirees' plans. Joining me to provide an overview of the current long-term care landscape is Morningstar contributor Mark Miller. Mark, thank you so much for being here.
Hi, Christine.
Mark, this is a hot topic whenever
Yes.
I'm speaking to groups of retirees. The room goes crazy when long-term care comes up. So I'd like to discuss the state of long-term care. Let's start with the costs of long-term care. What sort of rate of inflation have we been seeing in long-term care expenses?
So it's generally been going up anywhere from 4 to 5% a year, depending on which segment of care you're looking at.
Okay.
It's home-based or institutional, private nursing room, semi-private, but that's the general ballpark.
Okay, so much higher than the general inflation rate.
Definitely.
Okay. Let's talk about how retirees and pre-retirees especially can handicap the odds that they'll actually be on the hook for some of these costs. How should they approach that decision making?
So Rand Corporation did a study that came out last year that's interesting. In general, you'll find numbers out there that there's sort of a 35% chance that you'll need to be in a nursing home sometime in your life, for a very short period of time. Rand broke it down much more specifically looking at numbers for different age groups. So looking at people in their late 50s to early 60s, the numbers are telling them that 56% of us will spend at least one night in a nursing home during our lifetime. There's a 10% chance that you'll spend 3 years plus.
Okay.
There's a 5% that you'll spend 4 years plus. I think those are the really interesting numbers because that's where the costs really come in if there's a very extended need for care. So think about that 3-year number. At the same time, the national average rate per month for a private nursing home is $8,000. It's higher in more expensive states, $9,500, $9,600 in California, for example. So you think about how those numbers can start to mount, and that's where people start going crazy when they're talking to you.
Right. And what I always like to point out is that if you're part of a married couple, sometimes you don't have those costs that you're not incurring those costs simultaneously. You might have those costs incurring for both partners at various points in time.
It could, but there's two sides to that coin because in many cases, for a married couple, one spouse who's healthy takes care of the other, at least in part. So hard to say exactly how that washes out.
Okay. Let's talk about the trends in terms of long-term care insurance premiums. We've seen a lot of people who thought they were doing the right thing, purchasing the insurance, end up with these terrible premium hikes that they've had to contend with. Have we seen any stabilization in terms of premiums?
Well, some. The problem is the headlines continue to be unstable because a lot of these policies that were sold in the early going days of long-term care insurance were not priced properly. The insurance companies didn't do a good job of pricing out the risk in a number of different ways. And the benefits were very generous. You'll run into people, I still talk to people who say, boy, I bought my policy a long time ago and it had these great, unlimited lifetime benefits. Well, those policies were poorly designed and poorly priced. So we've seen this history of companies putting through double-digit rate hikes. They've averaged on 20%, sometimes higher. Very scary numbers. So the industry has gotten a black eye from that, and a lot of carriers have stopped writing new business.
Well, that's a question. Fewer companies in that business altogether. That's usually not a great scene for consumers, right?
Now, a lot of the experts who study this market think that things are stabilizing in the sense that the players who are left have better experience, track records, know how to price the policies properly. So they're more expensive at the get-go now, but perhaps less likely to see the big increases. There's no way to guarantee that. But a lot of smart people who study the business think that we may be through the worst of that.
Okay. So that's the pure long-term care insurance policies. Another trend that has been coming on strong is the uptake of hybrid long-term care policies. Let's talk about what those are first and then talk about the trend that we've seen in that marketplace.
It's a universal life insurance policy that has a long-term care insurance tacked onto it or inside of it, either as a rider option or right inside. So you convert, one option, for example, is the ability to convert a death benefit to a long-term care benefit. There are 2 or 3 flavors. They come with different varying levels of benefit protection. But the thing that's been striking over the last few years is that sales of these policies have overtaken sales of traditional policies. Now, in one sense, that's not saying much because sales of traditional policies are down 60% since 2012. It's
in part because of these premium increases.
It's cratering. I mean, part of it is fear of the product from the rate hike standpoint. I think part of it is just human nature. People don't want to think about this. They don't want to plan for it, and they don't want to pay for it. So, and the policies are not cheap. So, on the one hand, the traditional market's way down. It's selling about 90,000 policies a year. These new hybrids, at the same time, are growing. They're now selling roughly 250,000 policies a year. So that's kind of a striking change. On the other hand, if you add it all up, it's still not a real lot of activity, considering the need out there in terms of the potential population that might want a policy. That RAND study I mentioned concluded that maybe 12% of the eligible buyers or people who should be thinking of having coverage have it. So, we're looking at still a sea change in a segment of the market that overall is kind of small.
Okay. One thing I know you've looked at, Mark, is long-term care expenses, with the exception of people who might be eligible for Medicaid-covered long-term care late in life, just continues to be this big unfunded wild card for many older folks in this country. Any thought about whether there might be any movement afoot in Washington to address this gaping hole for so many retirees?
Well, Medicaid does remain the big player.
Yeah, right.
It funds 2/3 of long-term care need. Now, a couple years ago, several bipartisan organizations brought together some of the smartest experts in the room to think about what would be an approach to solving this and getting a less patchwork approach to the way we protect against this risk. And the consensus seemed to be that a smart approach would be kind of a hybrid public insurance, social insurance, if you will, and private commercial hybrid approach, where you'd have something like the Medicare program, for example, providing a base level of coverage. We would all contribute to that, to some incremental change in the payroll tax. And then you'd have the ability to tack on higher levels of coverage privately. Almost the way you think about the Medicare market now, where you have kind of the base level of coverage for hospitalization and providers, but then you can pull off the shelf other
The
things.
supplemental type
Supplemental
policies.
coverage and drug coverage
Right.
and the like. It's a successful approach. It's worked very well so far in Medicare. But if you did that, it would allow you to provide cheaper private coverage, because you'd be taking some of the demand for services out of those private policies. So, I think that's the approach we should be taking. Unfortunately, given the state of play politically, there's no sign of movement on it at all right now. But at some point, I think that's where we need to still get back to, is a discussion about a new framework for providing long-term care, because it's kind of the unsolved part of the puzzle, I think, in terms of the overall retirement safety net.
Right. Mark, always great to get your insights. Thank you so much for being here.
My pleasure, Christine.
Thanks for watching. I'm Christine Benz from Morningstar.com.
Can your portfolio weather the market? Use our premium portfolio tools to identify risks and streamline your holdings. Get started today with Morningstar Premium.
Next up, Russ Kinnell talks high yield.
Hi, I'm Christine Benz from Morningstar.com. Everyone loves income, but sometimes a high yield can be a harbinger that a fund is taking a lot of risks in its portfolio. Joining me to discuss that topic is Russ Kinnell. He's Director of Manager Research for Morningstar, and he's also editor of Morningstar Fund Investor. Russ, thank you so much for being here.
Glad to be here.
In the March issue of Morningstar Fund Investor, you wrote about yield and the connection between yield and risks in a portfolio. And you wrote that sometimes yield can signal that there are problem spots lurking in a portfolio. I thought it was really timely. So let's talk first about, you advise investors to do a little bit of math, to look for the expense ratio, look for the current yield, add them together. Why is that?
So a fund's expense ratio is subtracted from its income, and therefore to understand the portfolio's yield, you want to add back the expense ratio. That'll tell you what the portfolio is yielding. And when you get a really high yield, that's a big red flag. Today, we've had such a long-running bond bull market that yields are pretty low. And so if a fund's got significantly higher yield than its peer group or benchmark, that tells you it's taking on significantly more risk, and therefore you really want to be sure you understand what those risks are.
And a high expense ratio, high yielding fund, that can be a particularly scary combination.
Exactly. The higher the expense ratio, the more risk you've got to take on just to get even with the peer group. And if you want to do more than that, you got to take on even more risk. We've done studies in the past where we find there is a direct link between expense ratios and risk. The higher the expense ratio, the more risk the fund's going to take on to justify that fee.
Okay, so let's delve into some common sources of yield, ways that managers can bump up the yields from their funds. The most common is simply taking some credit risk, so being willing to delve into junkier bond types. How common is that, and in what category should investors be watchful?
Yeah, it's very common to see junk added to just about any kind of bond fund. Your typical intermediate bond fund might have a 5 or 10% in junk, so you really could see it just about anywhere.
So funds are limited, though, by their prospectus. So if I have a core, say, intermediate term bond fund, it'll have limits on how much the manager can put in bonds that are below investment grade, right?
Exactly. There will be limits. They'll need to have most of their investments in high-quality bonds. And our categories also have limits. So if a fund is mostly in high high yield bonds, we're going to put that fund in the high yield category.
Whether it likes it or not.
Whether it likes it or not.
Okay.
So there are some limits, you're right, but even so, it's worth understanding that this fund may be moving more into more aggressive areas to boost yield. And to a degree, certainly, we think sometimes that's a fine thing to do. There's nothing wrong with that, when it's done well as part of a good process with skilled investors.
Right, and that risk-taking certainly over the past even decade has been rewarded. Is it your sense that, and I know it's a big universe of bond funds, but is it your sense that managers are perhaps in some cases too comfy taking credit risk right now?
Probably, and I think individual investors are too, just because it's been so long since we've had a significant credit event. 2015, we saw a bit of a correction, but in general, taking more credit risk has paid off, and individual investors can kind of get lulled to sleep because when things are going well, more credit risk actually mutes volatility. It makes returns look more stable, and so you don't see that risk showing up in volatility the way equity risk just about always shows up as volatility. So it's a little more subtle effect, but it's something we want to keep an eye on.
Okay. Let's talk about interest rate risk. That's the other main lever that core bond funds have to take a little bit more duration risk than some of their competitors. How common is that today, would you say? Are managers nudging out on the interest rate spectrum knowing that the Fed appears to be in this tightening mode?
Yeah, I would say that some are, but some have gotten more defensive. So it's definitely a mixed bag. The good news is, one, that interest rate risk tends to show up as volatility, so it's a little easier to spot. But also the duration measure is a very simple way to understand a fund's interest rate risk. If you look at their duration relative to their benchmark and their peer group, that'll give you a good sense. And the higher the duration number, the greater the interest rate risk.
Okay. Another source of yield boosting that may be a little less familiar to some investors is taking leverage into a portfolio. Let's talk about A, how this works, and B, how that can exacerbate risks even as it plumps up yield a little bit.
That's right. So leverage is most common in the closed-end universe, where a lot of bond funds use leverage. The typical way to use leverage is you're borrowing so that and then you go out and invest the proceeds from that loan out into additional bonds. Thus, you're getting more than 100% invested, and of course that means you're dialing up the risk based on whatever you're investing in.
So it's a bull market strategy, really, but it can get you leaning. If you get caught leading the wrong way, it can be problematic.
For sure, it can really backfire, and of course it really means the fund is just more extended. Another more subtle way is there can be financial leverage where officially the fund is only fully invested, but you can own underlying instruments that really bump up your leverage, and so therefore de facto you see a lot of funds that have a little bit of actual financial leverage in there.
Okay. You brought an example of a fund that actually is you think a pretty good example of leverage in a portfolio and perhaps some risks lurking in a portfolio. That's Salient Select Income. Let's talk about that one.
That's right. We rated the fund negative because it really ticks about just about all of the risk boxes. It's got liquidity risk because it invests mostly in REIT preferreds as well as REIT high yields and REIT stocks, but also with leverage, it consistently is about 10 to 15% levered, but sometimes all the way up to 30. And what really gave us pause was the fund sometimes uses that leverage to meet redemptions, thus signaling one that it has some liquidity issues. That maybe it owns some non-rated securities which tend to not trade very easily, and so when we see a fund using leverage to offset flows, that really worries us.
Yes. Another source of yield boosting is investing in illiquid bonds. Let's talk about the connection there, why less liquid bonds might tend to have higher yields, and also what the risks might be of such a strategy.
Sure. If you look at treasuries or equities, most funds have all the liquidity they want. They trade tremendously. When you go into some bond areas, munis, and especially lower quality or non-rateds, they don't trade a lot. And so therefore the funds are taking on some liquidity risk. In other words, if they get redeemed a lot, they might not be able to sell enough to meet those redemptions, or if they can sell, maybe they have to sell at a really bad price. And of course, then you start a spiral of bad feedback where the fund sells at low prices, performance plummets, more people redeem, they sell more, and so it can be a real mess. The most dramatic example, and again, this is a real outlier, is Third Avenue Focus Credit, which ended up having to prevent investors from leaving because they couldn't meet redemptions. They had a very concentrated portfolio in small, low-quality energy issues mostly. So when energy had its problems in 2015, the fund couldn't meet redemptions. It's just about worked out all those problems today, which means essentially it's taken them 3 years to liquidate that portfolio, which is kind of a crazy thing to have in a 40 Act fund that's supposed to have daily liquidity.
Right. And so you mentioned that that's an extreme outlier case, but we actually did see during the financial crisis a lot of the issues we saw in bond portfolios were liquidity related, right?
Yeah, so one of the scary things is there are some bonds where the market looks liquid and then it's not. And so what we saw in 2008 is some forms of mortgages were liquid and then they stopped being liquid. And so funds had the difficult choice of they could either stop investors from redeeming or they could sell but at a reduced price. And some funds chose one option, some chose the other. But in any case, it was really ugly. And so that is one of the quirks of the bond world, is just liquidity isn't a given, and you really want to understand how the fund does that. But I think it also illustrates the importance of really good management that you trust, a really good process, because the good managers know this is a risk and they view different buckets of their portfolio. So they'll say, we're going to have some cash, we're going to have some more liquid holdings, and they really stress test their portfolio, and they understand that today's liquidity might not apply to tomorrow. So again, really be careful with your bond funds. Pick good managers, pick good processes, pick a firm you trust. Good stewards are much less likely to have these problems.
So if you see a yield, you're attracted to that yield, definitely dig in, get to know the process, get to know what's driving that yield up.
Yeah, the higher the yield you go for, the more risk you're taking on. So therefore, the more research you have to do. Just as you have to do that with an individual bond, the higher the yield, the more research you have to do.
Okay, Russ, thank you so much for being here. Always great to get your insights.
You're welcome.
Thanks for watching. I'm Christine Benz from Morningstar.com.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Now Dan Wasiolek makes a case for Expedia.
Most travelers are aware of the online travel brand Expedia, but clients should be mindful that the company possesses a powerful network effect and currently trades at a substantial discount to our $175 fair value estimate, offering investors an attractive entry point. Expedia's shares price has underperformed recently due to the market's ill-advised concern over increasing competition and investment. But in our view, Expedia's market position is unwavering with no signs of cracks, supported by solid trends in its international and vacation rental segments. This reinforces our stance that the firm's incremental spend in these divisions is justified and being done from a position of strength versus weakness. And despite this spend dampening Expedia's near-term profits, we see it as a strong use of capital, supporting its around 10% average annual bookings growth the next several years versus the roughly 9% rate we expect for the industry. We also believe these investments stand to buoy Expedia's leading network of 600 million monthly visits and nearly 2 million properties, which is the source of our narrow moat we award the company. The meaningful discount to our valuation implies the market seems to assume consistent share losses for Expedia, largely writing off any benefit from the current actions to bolster its network advantage. Therefore, we recommend long-term investors buckle up and travel with Expedia shares.
Go from one investment analyst to 150. Sign up today for Morningstar Premium and let our independent and unbiased research staff help you find the best investments. Get started today with Morningstar Premium.
Next, we offer 3 utilities for dividend seekers.
With the rise in interest rates the last couple of months, the utility sector is now open for stock pickers. There are several utilities trading at 20% discounts, but all of them face challenges. We now think, on the high-quality side, there are 3 that offer good value for investors, especially those looking for dividends. One of those is Dominion Energy. It trades at a 15% discount to our fair value estimate and a 4.5% yield. With good growth, we think this is an attractive total return, especially with interest rates still low. Another high-quality name we think is trading at a discount is Duke Energy. It trades at a 10% discount and a 4.5% yield. It's going to have slower growth, but still a good total return for investors. And finally, Southern Company. It's trading at a 5% yield and a 10% discount to our fair value estimate. It faces some uncertainties related to a new nuclear program, but we think it'll resolve those and ultimately give investors a solid total return.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.